Thank you for tuning in to Energy Views by Petrochemical Strategies. It has been a busy week in energy markets. Let's start by looking at crude and refined products. Earlier this week, the U.S. Energy Information Administration released its updated short-term energy outlook. They cite the number one factor for uncertainty in energy markets as Russia's invasion of Ukraine and subsequent sanctions on Russian oil. However, we cannot forget about OPEC's production discussions, U.S. natural gas production rates, and less robust economic activity as contributing factors to energy uncertainty. As you can see in this chart showing year-to-date NYMEX futures for WTI crude, New York Harbor RBOB, and number 2 heating oil, things have been relatively quiet lately. Taking a closer look at the last 30 days, crude futures have been mostly in the $90 to $100 per barrel range, and products have followed. The average price for retail gasoline was $4.56 per gallon in July. At the same time, diesel was $5.49 per gallon. By the fourth quarter of this year, the EIA is forecasting retail gasoline prices to be down 78 cents per gallon and diesel prices to be down $1.10 per gallon. As you can see by this chart, the 3-2-1 crack spread has been coming off over the past several weeks, but it is still much higher than it was at the beginning of the year and continues to indicate very good refining margins. As a result, run rates are forecasted to be 93% at U.S. refineries in the third quarter of 2022. Margins for gasoline and diesel are at historically high levels while inventories are low. In my past blogs, I talked about what I think are the leading indicators in the energy market, specifically crude futures and the retail price of transportation fuels. WTI futures have a weak backwardation, which I interpret as the market being slightly stronger today than what we believe it will be in the future. And as I mentioned, the EIA is forecasting retail prices for gasoline and diesel fuel to go down by the end of this year. Even if transportation fuels fall faster than crude prices, and I remember forecasting that the national average for gasoline will fall below $4 per gallon sometime this year, I anticipate that refineries will continue to run at very, very high utilization rates and margins will remain healthy through the end of the year. Let's take a look at natural gas. U.S. natural gas is somewhat like a two-headed dragon at the moment. Month average natural gas prices have been falling over the past couple months. You can see that in this chart where I have included the Henry Hub month average spot price for May, June, and July with the futures contract price, all in dollars per MMBTU. The price decrease is due to additional supply following the shutdown of the Freeport LNG export terminal. It should be noted, however, that natural gas prices rose during the month of July due to increased demand. However, the month average price was below the June price. While U.S. natural gas prices have been coming down, July inventories were reported to be 12% below the 5-year average, and exports are expected to be up 14% from 2021, in part due to the early restart of Freeport LNG. Despite what is happening in the U.S., the big story is the Russian exports of natural gas to Europe, which are reported to be 40% less than they were at the same time last year. In fact, there are reports that the Nord Stream 1 pipeline, which delivers natural gas to Germany, is running at 20% of its capacity. The big question for me is whether there is enough natural gas and infrastructure to supply natural gas cargoes to Europe in the event of a major shortfall. Let's turn our attention to petrochemical feedstocks, or NGLs. In this week's Natural Gas Weekly Update, the EIA reported that ethane prices ended last week 8% lower than the previous week. Prices for natural gasoline, normal, and isobutane were also lower, with propane prices remaining relatively flat. NGL futures markets have an interesting structure at the moment. As expected, we see a weak backwardation in ethane and propane futures through the end of the year. Additionally, normal butane is in contango, which is expected as we move into the winter gasoline season. Natural gasoline futures are also in contango, which is a little unexpected given the structure of the crude and products curves. Let's wrap up by looking at petrochemicals. Ethylene futures have a weak contango through the end of the year, with propylene futures pointed in the other direction. Even though the futures for feedstocks and products are weakly backwardated or in contango, they point in the direction of light feedstocks and higher severity cracking. However, futures are not a forecast, so the only way to take advantage of this is to lock in your futures today. All right, it's time to wrap up. Refining margins are expected to be strong through the end of the year, despite forecasted declines in transportation fuel prices. Global natural gas is uncertain as we wait and see what happens with Russian supply. NGLs and petrochemicals are relatively stable, with maybe some upside for domestic petrochemical producers. Thank you for watching Energy Views, presented by Petrochemical Strategies. My name is Robert Sawchuk, and I will see you next time.